We have a fairly rare day to start the week in the S&P, and today our focus is going to be on Intel. Now there's not much movement on this stock right now, however there was some big news that was released today, and as the headline suggests, Intel's CEO was ousted by the board after his disastrous performance of this company under his tenure. Now what's interesting to note is that the article today has come out to say he has retired from the company effective December the 1st. So that was yesterday, which may leave us to believe that actually he did go against his will, given the fact this news was released very abruptly. We can also see some of the issues this company has faced, one of them the inability to crack the AI market, and that is shown due to the fact, and we will come to show you, the share price is down 52% year to date. Now we can just look towards last year to see where some of the issues did start to crop up. In fact, when a company does cut their dividend by over 65%, we can already see that there are some issues, and in fact at that point in time the company did announce quite a lot of compensation cuts. And then we move to this year in August where we get some more cuts, in fact 15% of the workforce. They had a very poor quarterly guidance miss, and we can see their earnings as well were nothing great either. In terms of the actual numbers for the period, well, we can see they reported 2 cents on the EPS. Market wanted 10, that is a very large miss, and the revenue, as we can see, did come under, even though marginally 12.83, still below the 12.94 the market wanted. Not only that, but the company, which had cut its dividend by more than 60% in 2023, said that they will not be paying a dividend in Q4, and that will lower their capital expenditures by over 20%. So there wasn't too much great news for this company, and then we can see their most recent quarter did give some hope for investors, where the shares were up 8% on both an earnings beat as well as lifting their forward guidance. Now how good were those numbers from the more recent quarter? Well, very impressive, 17 cents versus the loss of 2 cents the market anticipated, and they also beat in terms of the revenue, 13.28 versus the 13.02 billion. However, if you do want to compare it in terms of the same quarter last year, it still showed the issues that did lie with this company. It was down 6% on a year-on-year perspective, and we can see they registered a net loss of around 17 billion for the quarter. When we compare it to the same one last year, it was, although small, a 310 million net profit. So we can see issues have started to pile up with the company, and we actually get a note from this more recent earnings where the CEO, or we should say ex-CEO now, said on a conference call that they are having a restructuring process. However, what he didn't realize, he would be one as part of that process. We also know not too long ago where he did say he does respect the skepticism that he has noted from investors, and at that point in time they had their worst day in over 50 years following one of their poor quarters in 2024. Now, in terms of some good news for this company, we do in fact note just last week they did finalize a very large agreement, in fact 7.9 billion, in which the grant will help Intel's chip manufacturing expansion, and we do believe with the upcoming president taking place in January, he is all for having things manufactured in the US, and that may help this company moving forwards. However, that remains to be seen as to how strong this will be for the company that has been hit very hard, not just over the last year, but also for quite some time now. In fact, over the last 12 months, down around 47%, year to date around 52%. If you've been a longer term shareholder, well, unfortunately the news isn't great either. If you had invested $10,000 into this company 10 years ago, you would be sitting right now around $6,500, so you would have lost quite a substantial amount. Not something any investor wants from any of their investments. Right now this company does sit towards its 52-week low. We did notice actually today this company on the back of that news did in fact go up a few percentage points, as we can see around $25.50. Right now though, the market has digested that information and it does look to be fairly flat on the day, down very marginal. In terms of buy ratings, well, only one from Seeking Alpha, both Wall Street and Quant give this a hold, and the earnings per share on a forward basis not looking particularly great at negative 0.15. Now we also like to incorporate whether or not insiders, institutions are buying or selling, and what we notice, the ownership is very low from the insiders, and we have around $650,000 worth of sales over the last year, with a little bit more buying, both very trivial amounts in the grand scheme of things, but we can see the most recent movement was a sale in Q4 of 650k. When we take a look, it was the EVP on the 7th of November, so a few weeks ago, selling around 25,000 shares, netting her 650k. Important to note that insider selling isn't something we consider a bearish signal, as they sell for many reasons, personal or financial. In terms of the institutional approach, well, ownership sits at 65%, around 7 billion worth of sales over the last year, with a substantial amount more buys, around 12.93 billion, again during the same time frame. However, what is interesting to note is that over the more recent quarter, Q3, we do see a little bit more selling by the institutions rather than buys, and with this news it will be very interesting to see if that trend does continue. We also note in terms of earnings moving forward, it does look very inconsistent, and when we look to the past 4 quarters, they actually missed 2 of the 4. In fact, the 2 most recent ones were misses. Q3, as we saw, a substantial miss. That gives them a 50% track record, and as we can see and have mentioned, earnings per share estimate for this full year at negative 15 cents. Over the next full annual accounts at just under $1, which will bring this forward P to around 24.32. Now, one element of our review are some of the gradings. Now, they get a D+ overall. We don't have any of the P non-GAAP numbers here due to the fact that, as we saw, the EPS for this year will be negative. But if you do look at other metrics like the EV to sales, EV to EBITDA, they do get a fairly favorable score in the B and the A range in terms of the price to book. So it is a little bit complicated to really come to a conclusion in terms of the grading. However, Seeking Alpha have deemed this to be a D+. We then move on to the growth, where they get an F. Now, year on year, 2.6%, not great. Remember, what we typically aim on the channel is at least 4% to keep up in line with inflation. That is where we see the sector median right now. Forward looking, they're anticipating their top line to be down, negative 4%, sector median around 5.7, and we can see one thing that does look good from this company is the EPS. Again, if you believe management and their forecasting accuracy, 25% over the next 3 to 5 years, with the sector median around 15.4. We also notice on the profitability, they sit at a grading of A. Now, gross margin coming under 40 versus 50 from the sector median. Bottom line, negative 29%. No surprises, as we just saw from that more recent quarter, they did report a net loss. Sector median, while very small, at least positive at 3.9%. One of the reasons why they do get a very good rating on the profitability is their cash from operations over the last 12 months sitting very high, 9.8 billion, when in comparison we can see the sector median at 97 million. Now we can have a quick look at some of the underlying metrics, but as we see, this company has had a few dividend cuts over the last few years, but over the last 20, when they were paying a dividend, the increases was fairly attractive at 12%. Unfortunately, right now, no dividend is to be paid, and the free cash flow data therefore does become irrelevant in today's episode. But as a reminder, on this channel we do tend to ignore the earnings data, as we do believe it to be susceptible to manipulation by management through their accounting. Free cash flow per share, while negative over the last few years, it has been fairly decent from 2014 to 2021, but as we can see, the last 2 looking negative, not something we ideally want to see. And then we can see the struggles they have had on their top line over the last 2 years, double-digit negative growth. Nice to report on the trailing 12 month, we get 3%. Hopefully, at the bare minimum, they can keep up in line with inflation. But as we can see, quite a drop from the highs of 2021 at 79 billion to 54 in the more recent annual accounts. Now, shares outstanding, we highlight this to show companies that return excess cash to investor pockets through their share buybacks, something Intel did up until 2021. Since then, though, they have started to do the opposite and issue shares, thereby diluting your position as a shareholder. And these are just points to remind you to understand when you do look at your own investment thesis to incorporate all of this information, and that is why we ultimately, at the end, also look at a margin of safety. ROIC, one of our favored metrics, 10% or more, give us faith management are able to effectively allocate their capital. We get that up until 2021. Unfortunately, last 2 years, it has slipped and quite significantly. We then move on to the operating margin, where again, very similar trend here, very strong up until 2021, not looking good over the last 2 years. And those comments are pretty much mirrored when we do also analyze the free cash flow margin. In terms of net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization, for companies in this industry, we want below 1.5, something we have seen them go higher in 2023 and on a trailing 12 month. Remember, this metric correlates to dividend safety. Now, they don't pay one, so irrelevant, but also the balance sheet strength. And we also know, for those that want to understand, these numbers essentially tell us the number of years it takes the company to pay off all of their debt net of cash on hand. On a more positive note though, it is anticipated to come down over the next 12 months. With all the restructuring, with all the cost cutting, we do hope they can start to delever the balance sheet a bit more and continue to reduce this. Now, before we jump into our own valuation model, we want to let you know we have just released our latest free weekly article today, where we highlight 2 cheap stocks that are under the radar. Now, we deliver one to your inbox every single Monday morning, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued dividend stocks for the month of December to buy. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, a recently released copy of 29 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We then move into the valuation, where our intrinsic value comes to $28. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, how we got to $28? Well, we ran it through the DCF model, where we have the free cash flow year on year. We can see the average is negative due to the fluctuations over the longer term. Now, moving forwards, we've gone for a growth rate of 0%. Maybe you consider that to be very conservative. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, based on this, we get upside of 19%. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, where it is for Intel or any others. The full transparency will show you here at the 4% rate. This would indicate an intrinsic value of $38, and at the 8% rate, we can see this would be bang on 50, indicating more than a double with 111% upside. Now we're going to take through the very conservative rate of 0% today, and we always like to apply a margin of safety on this channel, 10%, and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode a buy at around $25, then we keep going till it's near the current trading price. Now, it's not a 20% MOS just yet, but for Intel we see around 15%. In terms of Wall Street, they don't see much upside over the next year. Their price target of $25 indicates only 5%, which isn't that great. As always though, do give us your thoughts below. Maybe you believe this is a very bullish signal for the company moving forwards. Maybe you like the CEO, this wasn't a decision that you wanted. Let us know below. And as always, if you did enjoy the episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.